G'day traders, Mindset Reset. It's Tuesday, day 2 on the front side of the week, Free Cash Tuesday. Today I'm going to answer some specific questions that came in regarding some traders getting chopped up. And also going to talk about day 2, the front side. And one of the criteria that traders can use if they're struggling or if there are challenges, we're going to talk about a couple of key things that may help them obviously recognize best trade candidates and the patience to sit on their hands. Now today we had several opportunities starting in the Asian session and in the London window, and then of course in the New York session. Now let's talk about first things first. Trader asked a great question today, and that was, I keep getting chopped up on the 1-minute chart. Is there an easier way, or is there some tips that you can give me to help prevent that from happening? Now, I'm going to suggest right away, the only reason you should be on a 1-minute chart is if you already have the expertise and you're melding that with your shorter time frame template setup. So a 5-minute chart, and you're finessing your way or scaling into a larger time frame opportunity. And the reason why I say that is if you're using a 1-minute chart and you don't have that skill set or that consistency or the runs on the board to support that, stick with what's simple and easy. A 5-minute chart is all you need. Now, if you're getting chopped up, I'm going to suggest that you go back to the very simplest criteria, and that's where I talk about my friend Steven. My friend Steven doesn't touch a market until it breaks out, and he will not enter a trade until the 3rd hour. And what that 3rd hour does on the front side or the back side, depending on if you're trading currencies or metals indexes, commodities, energies, what that does is it gives you the patience. So a lot of traders want to get in right away at 9:30 or 8:30, and there are some opportunities, as we saw on some explosive moves right off the bat this morning on indexes that took traders, NASDAQ, S&P into the high of the day. Now I want to talk about that for a second as we're talking about this. One of the things that is important to understand, if you go back and look at your S&P and your NASDAQ charts, at 9:30, they were at closing price. So everything to the left of that, in a large majority of cases, is what I refer to as the Fugazi. And so traders see all that price action, and one of the things that's key is that we're already in breakout on the indexes. And on those two instruments, they went back through the high of the day, high of the week in this particular case, and engulfed 3rd hour. And a classic textbook example of 30 minutes working the high, engulfing 3rd hour. My friend Steven, a little 5-minute pullback into that engulfment candle for the collapse down through the low of the day. We had trap volume above closing price. And one of the most important things to understand on a day where there is no major red news is the patience to sit on your hands and recognize that the open is taking you into the extreme. Now, there was a nail and bail opportunity from closing price to high of week. And then, of course, the 3rd hour reversal. So the willingness to sit on your hands and just be patient. You shouldn't be using the 1-minute chart. Once you've got that consistency and the runs on the board, and the most important thing to understand, even with your 1-minute chart, is time of day. You know, I make a joke of that all the time. If you can count to 3 and tell time, you can make a lot of money. And there's no joke about that. But traders often want to they're chasing the 1-minute candle. They lose all concept of everything else. They're just looking at these candles. And so remember, the clock is your best friend if you understand how to use that. So get off the 1-minute chart, stick with 5-minute time frames. We're in day 2. We expanded the range. 3rd hour kicks in, we reverse, take out the low of day, pull back inside and consolidate. That's a day 2. So when a market breaks out and it's in no man's land, remember that it will often, especially on the front side, take a day now to consolidate sideways. Some traders were looking for a huge move all the way down. We got that on the Russell. It broke out and coiled sideways into the open before going parabolic into the New York Open, straight down to the low of the day. Different than S&P and NASDAQ. So depending on which instrument you traded, those opportunities were subtle variations of a market on a day 2 that reversed from the high of the week. Now, another question I received was on gold. how can you have a lower low on the inside when the market hasn't taken out a low of the day? And that's a great question. So key thing to understand today on gold, we're already in breakout. We're already in breakout. We're in no man's land. 930 opens at the high of the week and takes out the higher level longs. Now that, if you go back and look at your longer time frames, triggers hourly 4 hour in the next 4 hour candle, but that's a break in structure in a market that's out of balance. Now that's different than a market that takes out a low of day level and does a range expansion on the downside, which can also start a pump and dump, but that can align with a measured move opportunity. So a market that makes a lower low, a range expansion pumps up, can break down now for a measured move range expansion. We have a market that's broken out on gold. We've worked the high of the week. New York Open has taken out higher level longs. They pumped it back up into that peak formation made at 930. End of that third hour, the market breaks down and we do a measured move of that upper box back to the high of day level. So understand the difference between the two. We're still in a market that's in breakout. It's driven by other time frame buyers. We may see that market break down and reverse Wednesday, Thursday, Friday. No idea. We have an FOMC release tomorrow, a single part release, Powell, I believe. But that's a different type of opportunity. That's a reversal as opposed to a range expansion, high of week, a market that's breaking a low of day level, pumping up and rolling over for a measured move back in the other direction, in the reversal direction. Front side of a week, a market can expand the range. On the back side of a week, the market can reverse the range with a measured move back inside of that high-low of the week range. So a big thing to take into consideration on the currency pairs, for example, Swiss franc, we saw a beautiful range expansion. So a market that broke down, made a lower low, pumping up and rolling over in the London session for a range expansion opportunity. That market did the same thing into our US window, a low-hanging fruit, pump up, range expansion, continuing in the line of that trend, driven by other time frame sellers. So just an example of day two reversal, currencies, indexes. We saw range expansions, metals and indexes. And then we saw range expansions that continued low-hanging fruit on some of the currency pairs. Euro Swiss was a great 2-day pump and dump template. Day one made a high, opening range. They lower low on Monday. They pumped it back up into the Tuesday. They broke down and coiled underneath of Friday's closing price, where all auction process starts from, for a vertical parabolic short trade to the low of the week on day two out of the London session. Now the next part of this conversation is understanding when you don't have a setup. So you see parabolic opportunities. We had third hour reversals. We had a coil on Russell. I haven't quite gone back and looked at the Dow Jones yet. I know it broke down. How much, I'm not sure. We saw range expansions on currencies, which is an exact support of why I say to traders, just because something's down low or up high does not mean that you automatically just counter trend it, which comes back to comment that I talked about yesterday, is that we're on the front side of a move. Those daily levels represent other time frames, daily, weekly, 4 hour, hourly, and reinforcing your muscle memory. Which trade setup have you mastered? I like to short things, so markets are in breakout. I'm looking at those. I'm watching what happens, but I'm also content to sit on my hands and wait. I put some charts up, and a trader's saying, well, where's the trade? Where's the trade? Where's the trade? I want you to understand something. If you're looking at charts that are up there saying, where's the trade? Where's the trade? Some of those are going to be trades that are already over, and there's some of them are just setting up. Now, if 930 opens up, and I repeat this almost every single video, my friend Steven doesn't trade a market until it breaks out, and not until the third hour. If you aren't consistent, be willing to be patient and just wait. Let the market set up. Very rarely are you going to have a market that just takes off at 9:30. Now it does happen, especially on the front side of a week, as we're expanding the range. But we had markets that already had day one range expansions. We opened up right at closing price and went to the high of the week. How does price behave when it gets there? The end of the hour presents and engulfs. S&P was textbook perfect, probably the best of that in terms of reversals. The Russell obviously coiled and rolled over, taking out, I believe it went to the low of the day, which will now be a break in structure on the inside. We saw some great opportunities on the yen cross pairs right off the bat in Asia. Markets that had broken out yesterday pumped up in the US window and a little bit higher in the Asian window just at the open for a vertical stop hunt trade. 75, 100 pips on a couple of the crosses, parabolic. And again, nail and bail. So you get a parabolic move that fast, and if you aren't locking in the money, then again, there's another reflection from the market about not understanding the trade setup that you're in. You've got a good 15, 20, 35, maybe 40 minutes to be locking in the money. That's plenty of time for you to preset profit targets for the market to take you out as it's blowing through levels. I repeat this all the time. I preset a lot of targets. As soon as I'm in the trade, I'll start putting profit targets into the system so that as it goes parabolic, in case it spikes back up, it's taken me out with profits. If I have a trailer left or whatever, I can manage that myself. But I want to be taken out when a market goes vertical and spikes through a level. And what that allows me to do is not have analysis paralysis, hold on, hope for more, not sure what I should do. I do it automatically as soon as I'm in the trade. So if I'm scaling in, I'm putting that in right away before I scale the next position in. And what that allows is that it guarantees that when the market blows off, it's taking me out and I'm getting paid. I'm getting paid, and that's the name of the game, getting paid. It's not to see if I'm right or to prove anything. I'm in a trade. I want to get paid. That's the name of the game. It's nail and bail on the front side. It doesn't matter whether it's a 150 pip move or a 50 pip move. Whatever that trade offers you, take the money, get paid. So if you're in a market that's making new highs, and we haven't broken a daily level yet, it needs to break down first, which means it's possibly going to come back up before and get lower level shorts or whatever before it rolls over, because as I mentioned, when a market's in breakout, it usually will take a day to reestablish its boundaries. And when it reestablishes boundaries, now we can get a first red day. We can get a first red day trade set up, but typically you won't see it roll over all the way to a low of day level. We saw that on the Russell today. The other indexes have pulled back up. We may see them break down tomorrow. But the important part is, depending on the template that you've traded, is that you get paid. Like Bill McLaren told me this and repeated it. Learn to take a profit. A critical, important factor about why you are here. Traders are often trying to get in and hold on to something. They get stopped out at break even, or they hold on to something and it ends up being a pullback in a market that's broken out. Understand that. You get a first red day and it breaks down the next day. Now you could have a market that's going on a day two range expansion on the backside of the week, whatever that is. But make sure you get paid. So oil is a great example. It gave a dump and pump template, a coil, which gave an auction back and forth into the breakout, the lower level shorts from yesterday's breakout, into the end of the second hour. Beginning of third hour, it rolled over with a nice parabolic short trade. So an opportunity on the long side, a nail and bail. Again, we're counter trending other time frames. A parabolic move, third hour, down into higher level longs. So if you didn't take the money, or you didn't lock in any profits, or you didn't move your stop, whatever, you were sitting on a trade that gave you nothing when you're in the money. So reinforcing, recognizing what type of setup am I in? Is it nail and bail? Is it a range expansion opportunity? And then making sure that you are paying attention to the time of day, the clock. New hour, bang. Market rolls over and gives a nice parabolic short trade, which several traders nailed today. That comes with experience. My suggestion would be again, for traders, if you're trading the bigger markets, the indexes, the metals, to be patient and look for third-hour opportunities. My friend Steven makes it really simple for himself, and he doesn't care if he misses a market that's moving. You know, there'll be several times where we'll see 3 indexes go crazy before 10 a.m. And lo and behold, there's always an opportunity for Steven from 10 a.m. onwards. And it reinforces being patient and being willing to sit on your hands and not feel like you're missing out. And he doesn't even care if all of them move without him, because his rules say, I don't trade anything until it breaks out, and I only trade reversals, and I don't do anything until the 3rd hour. And 90% of the time, they meet his criteria. One of those will meet his criteria. The S&P was a perfect example of that today. So in closing, if you're struggling, take a look at that and see if that simplifies things for yourself. But you have to be willing to let everything else go and not have 10 charts up and looking for stuff that's moving to try and catch something. What setup are you hunting? Steven's setups don't even let him get in until 10 a.m. at the earliest. How simple is that? If it moves without him, he does not care. And he doesn't care what anybody else thinks. He knows exactly which setup he is hunting. And that's the setup he has mastered. And very rarely does a day go by when he's at the screen and we have a best trade candidate that he doesn't get a 3rd hour opportunity. Understand what that means. It makes it simple for him. It removes the science projects. And it also keeps him away from the screen until 10 a.m. So in closing, the key things today I'm trying to emphasize to traders if they're struggling is to just be patient, step back, give yourself that extra window, that 3rd hour patience to look for 1 or 2 best trade candidates. And even if you only take 1 or 2 trades the rest of the week, focus on candidates that are best trade setups that will show up again and again and again. We have markets that close and break out. We have markets that coil into that 3rd hour. For reversals, for trend trades, we've got some major red news. We're going to get backside opportunities. Be patient. Be willing to sit on your hands. Do not use the 1-minute chart. Keep things simple so that you can reproduce them and you can scale them up in size. Have a great day, traders, and may the markets go with you.